I'm Jonathan. Formerly I was a manufacturing executive, but more recently I have been a teacher at a university business school. For some time now I've been considering the effect on the euro on international competitiveness of member states. Now this is fairly complicated, so I've developed a model to illustrate the point. But before showing it to you, we need to understand some basic concepts. If we consider the pound sterling against the dollar, UK versus USA, when the pound is strong against the dollar, USA products are more competitive than those in the UK. When the pound is weak against the dollar, UK products are more competitive against those from the USA. Now, international competitiveness is not just a question of exchange rates. Products offered on the international market have to be of good quality, well designed and well made, as well as being competitively priced. Most Western economies are capable of producing well-designed, well-manufactured products. So the differentiating feature is increasingly exchange rates. If we consider the situation within the European Union, in particular in the Eurozone, those countries in the Eurozone have a common exchange rate in terms of the euro. However, if the euro was to break apart, the German currency would appreciate by some 30%, and the Italian currency, for example, would depreciate by about 20%. Therefore, the relative price of German products would be 50% more than those in Italy. The model is technically an hydraulic model, although actually it's quite simple. It consists of a plastic container 3/4 full of water. A smaller milk bottle represents the Italian currency. Again, this is partially filled with water. The larger milk bottle demonstrates the German currency, and it's larger because the German economy is larger. These are held together under euro, which is represented by a floor tile. And you can see that Germany and Italy share the same exchange rate against the euro. And to make it easier to read, I've a scale representing the exchange rate against the pound and the dollar. Roughly in the right place. Now, under the euro, both currencies have the same exchange rate of about $1.3 or 0.8 pounds approximately. However, if the euro was to break apart and the currencies were allowed to float, the German exchange rate would increase relative to the international market to something approaching $1.7 or 1.1 pounds. Whereas the Italian currency would depreciate by about 20% to something like $1.1 or 0.65 pounds. However, under the euro, the German exchange rate is kept down and the Italian exchange rate is kept artificially high. So Germany achieves a competitive advantage on the international markets of some 20 to 30%. Let us look at the implications of this. This applies not just to the European Monetary Union, but it also affects people in the UK, USA and other international customers. Because under the euro, the German exchange rate is being kept down and the Italian exchange rate is being kept up relatively. So Germany has a competitive advantage in terms of price of some 20 to 30% on the international market. We are all paying for that. So Germany benefits significantly from being part of the European Union. It is in Germany's interests that the euro survives. So for that to happen, Germany needs to be prepared to pay. If we take this example of the United States and the state of California, if California were to secede from the United States, its exchange rate would appreciate some 40% of what it currently is now. The fact that it doesn't is because it's part of the dollar zone and it maintains that relationship because it is part of a financial union as well as a monetary union. In fact, California has to pay. California pays a larger proportion of the federal USA budget and may even transfer funds from its wealthier states to poorer states within the United States Federation. A similar situation needs to apply in Europe. For the Eurozone to be maintained, there has to be a fiscal union, meaning there is a common fiscal policy under which wealthier states, such as Germany, pay a higher proportion of the federal expenditure and may even subsidise poorer states. The bottom line is, for the euro to survive, Germany must pay.